All right, let's jump right in. Today, we are cracking the code on a chart pattern that you see all the time but might not know just how powerful it is. I'm talking about the wedge. So let's grab our detective hats and figure out what clues it's leaving for us on the charts. You know that moment, right? You're watching a stock, the price is moving, and then it just kind of stalls. It gets tighter and tighter, and you're sitting there thinking, okay, what's next? Is this thing about to shoot for the moon, or is it going to drop like a rock? Well, here's the thing. That pause, it is not random at all. The chart is literally giving you clues. It's whispering secrets about what might be coming. And if you know how to read those clues, you can be the detective who solves the case before the big move happens. And that brings us to our main piece of evidence, the wedge pattern. Honestly, the best way to think about it is like the market is just taking a big breath. You've got these two trend lines that are squeezing together, and the price is bouncing between them. It's a huge signal that traders are getting indecisive, and that coiling action means a big move is building up under the surface. So in our investigation today, we've got two main suspects we need to look at. First up is the rising wedge. Now, you'd think rising means good, but it's typically a bearish signal, pointing down. Then we have its counterpart, the falling wedge, which, you guessed it, is usually a bullish or upward signal. Let's dig into each one. Okay, let's start with our first pattern, the rising wedge. And like I said, it slopes up, which looks positive at first glance, but don't let that fool you. This is almost always a bearish clue. So let's break down its anatomy. Take a look at the chart here. See those two lines both pointing upwards? The price is basically ping-ponging between them, making higher highs on the top, and importantly, even higher lows on the bottom. Now, here's the really crucial detail. See the bottom line, the support line? It's actually steeper than the top line. So what does that mean? It means the lows are climbing faster than the highs are. That's a subtle hint that the upward momentum is actually fading. The buying pressure is getting weaker, and that's what creates that classic price squeeze. And, as our source material from babypips.com says, with prices consolidating, we know that a big splash is coming. That tension is building up, and you just know a breakout has to happen. It's just a matter of when and which way. But here's the twist in the story. The direction of that big splash, it all depends on what was happening right before the wedge showed up. That preceding trend is the number one clue you need to solve this puzzle. Okay, let's look at case number one. You can see the price was in a nice, clear uptrend. Then it formed this rising wedge. And what happened after the squeeze? Bam! A breakdown to the downside. So in this context, the wedge acted as a classic bearish reversal pattern. The party was over. Now, what about case number two? Here, the price was already heading down before the rising wedge appeared. It was like a little pause, a little consolidation, and then, whoosh, the price broke down again and the downtrend just kept on going. So see, same pattern, same bearish outcome, but a totally different story. One's a reversal, one's a continuation. All right, let's flip the script and check out our second suspect, the falling wedge. This one is pretty much the mirror opposite of what we just saw, and as you can probably guess, it's typically a bullish signal. Visually, a falling wedge is really easy to spot. You've got two trend lines, both sloping down, both coming together. As the price bounces between them, it's making lower highs and lower lows, getting squeezed on the way down. And just like before, context is king. In this first case, the falling wedge shows up right at the bottom of a nasty downtrend. And what does it signal? A potential reversal. And wow, look at that breakout. The source calls this a huge upside move. And you can see why. It's a textbook bullish reversal. So what about our second case? Here, the falling wedge forms right in the middle of an ongoing uptrend. A great way to think about this is that the buyers are just taking a quick breather. They're catching their breath before they get ready to push the price even higher. And sure enough, once the price breaks out of the top of that wedge, the uptrend kicks back into high gear. So to put this all in one place, here is your official detective's cheat sheet. But you know what? The main takeaway is actually super simple. A rising wedge is bearish, a falling wedge is bullish. That's the core of it. The trend before just tells you if it's a reversal or a continuation, but the direction of the break is usually pretty consistent. Okay, so we know how to spot these patterns, we know what they mean, but how do we actually trade them? How do we crack the case and put this knowledge to use? Let's get practical. Well, it really comes down to a simple 4-step playbook. First, obviously, you gotta identify the wedge. Step 2, and this is important, you have to be patient and wait for the price to actually break and close outside the pattern. No jumping the gun. Step 3, you measure the height of the wedge at its widest part, right where it starts. And finally, step 4, you project that same height from your breakout point, and that gives you a potential price target.
Let's look at this in action. It makes way more sense. For this downward breakout, you just measure the height of that formation. See the blue lines? Then you take that measurement and project it down from where the price broke out. And look at that. The move is often about the same size. It's a fantastic way to set a logical profit target.
And guess what? It is the exact same principle for an upside breakout from a falling wedge. You measure the height at the widest point, and that becomes your potential target for the move up. It's just a beautifully simple and effective way to plan your trade.
So, let's wrap this up with the detective's final case notes. If you remember nothing else, remember these 4 things. 1. A rising wedge is bearish. 2. A falling wedge is bullish. 3. The most important clue is always the trend that happened before the pattern formed. And 4. The height of the wedge is your secret weapon for setting price targets.
And there you have it. The case of the mysterious wedge pattern is officially cracked. Now you know how to read the clues the market leaves behind. The only question is, where are you going to spot your next one? Happy hunting out there!